Investors are waiting on the Federal Reserve as well as a deal between the U.S. and China. Federal Reserve Chairman Jay Powell is set to lay out long-awaited details today of the central bank's plan to end the balance sheet wind down. $4.5 trillion expected to go all the way down to $1.3 trillion. We don't know if it's going to cap out at the end of this year or go into next year. We're also waiting on another round of high-level trade talks set to take place next week between the U.S. and China. Joining me right now is Senior Vice President with Fixed Income, Fixed Income, is Bryce Doty. Bryce, it's good to see you this morning. Thanks so much for being here.
Thank you for having me.
How important is what we'll hear from the Fed today? We got a very important pivot at the end of last year where we were expecting now no interest rate hikes this year. Some people are even talking about a rate cut. What are you expecting to hear from the Fed?
Yeah, as far as the rate goes, they're going to keep the target rate the same. I wouldn't be surprised if they actually do lower the interest on excess reserve. T-bills have started to tip up over the 2.4% they're currently paying on excess reserves. That bothers them. They don't like the fact that T-bills are now at a little bit higher yield than even 5-year treasuries. So I think that might happen, but everyone's focus is going to be on the balance sheet. How they're going to look for details. They're thirsting for how is it going to happen? Are they going to stop cold turkey? Will they taper? How are they going to reinvest maturities going forward? And for me, I think it's all about them re-steepening the curve. Frankly, I think they're sick of having to answer, the question about, hey, recessions inverted curves promise recessions. What are you going to do about it?
Well, I mean, that's the thing, and we're seeing real weakness across the world. Dagan, jump in here. We got FedEx out this morning, who's basically telling us that we're talking about a global slowdown. A year ago, we're talking about synchronized growth. Now we're talking about synchronized slowdown, leading some people to say maybe the Federal Reserve's next move is to cut rates, not this year, but at some point next year.
Right, and the expectations are so built up that if they don't say, they're going to stop reducing the balance sheet like right now, at least by this summer, I think the stock market could take a hit. The expectations have gotten a little overweighted. Yet the math just doesn't work. Powell said last month that they're looking at maybe a target balance sheet of $3.5 trillion. They're currently at $4 trillion. At the current pace, it takes at least a year for them to get from 4 to 3.5. So we're nervous about the market reaction from today's announcement. But you're right. This global weakness out there is starting to get people nervous. They're going to want to see action. But domestically, things are still really strong. The labor market, it's just crazy. The job openings still over 7 trillion. So they're kind of in a no-win situation, frankly.
Yeah, and then, of course, there's China, and we know that this issue in terms of the tariffs and the trade fight has slowed down China's economy. We've got new trade negotiations happening next week. Officials from both countries scheduled a new round of talks in both Beijing and Washington beginning next week. An agreement in late April is what some are talking about. Do you think the two can come to an agreement, and how important is that for the markets?
Well, first of all, they've gotten further than anyone thinks. Believe that they ever could get to. I don't think it'll be perfect, but I expect continued good news out of trade. Everyone keeps blaming trade for so many things that, there's probably some upside economically going forward. I think they will come to some sort of agreement and make huge strides. Will they get all the way to where they want to be? Of course not. Will China continue to find ways to, steal technology? Of course. But we can't go anywhere but up from where we were, and I think they are having a lot of success. So I think that that's some upside for the economy, not just domestically, but clearly globally for the second half of the year that people really aren't factoring in right now.
All right, Bryce, we'll leave it there. Would you put new capital to work right here, real quick?
I would. I'd be, in the bond market, I'd be nervous about the long end. The 10 and 30-year yields are barely over Fed funds. Where's your upside there? But I would be in corporate bonds, kind of in that 3 to 7 year part of the curve.
All right, we'll leave it there. Great to see you, Bryce. Thanks very much.
Thank you.
Bryce Doty joining us in New York this morning.